Welcome to Trader TV Equities, your insight into the trading climate for professional stock investors. I'm Dan Barnes. In January's show, we're revealing the impact of Europe's MiFID II rules on investment trading, which came into effect on 3rd of January. We're going to hear from McLoughlin, Head of Trading at Liontrust Asset Management, about the impact of the new rules on the buy-side trading desk. Matt, welcome to Trader TV.
Thank you for having me.
So the equity market was impacted under MiFID I in 2007, and now it's been impacted further under MiFID II. So there's been some change to the way that equity trading takes place. What's been the most unexpected impact from your perspective?
Well, I think it's still very early days, so we'll see. I don't think there have been too many unexpected impacts yet. I've tried not to make too many very firm predictions about what was going to happen as well, because we're going into the unknown somewhat.
Very wise.
But I think a lot of people spoke about how volumes would be very low at the beginning and then would pick up, and I think that's actually happened. But I think probably the most unexpected impact that a lot of people have seen is the dark pool cap delay. In hindsight, it's probably quite obvious that was going to happen with the amount of data that was required to get it right. And I think it is right to take longer to make it correct rather than rush it in and make a mistake. So I think it's a fair move.
And so the double volume cap was a way of limiting the amount of trading that takes place without pre-trade transparency, so without the details of trades being published beforehand. Clearly that's something that has been used previously by different trading venues. Some trading venues are lit, some are dark. Has that then had any impact on the way that you trade and your order routing process?
Well, it has, but not in the first few days of MiFID II. I think a lot of the work was done in Q3 and Q4 by us engaging with counterparties to see how they're going to interact with new and different types of liquidity, how their infrastructure is changing, their smart order routers. We also interacted with banks SIs and HFT SIs as well.
And they're systematic internalizers.
Indeed, yes.
Yeah.
So we wanted to see how those models are going to operate. And whether we like the way they operated and like the way they unwound their risk. Yeah. For those that we actually liked and understood their model as much as an outsider could, then we switched those on to re-interact with them. For ones that we haven't, then we haven't switched them on yet, and we'll wait for the data before making a decision.
The liquidity picture, how has that been notably affected by the change in volume?
Well, I think at Liontrust we trade across the market cap spectrum from micro cap to large cap and mid cap, and we trade again using algos and high touch desks and PT desks. So we've seen quite a range of different changes. On the electronic side, from early data we've seen, I think on average spreads have tightened in. So we're getting slightly better prices, but the actual liquidity we're finding at the touch has got a bit worse. So as a theme, we're getting better prices but worse liquidity, which is not really ideal. For small and mid cap stocks, we've seen similar appetite to cross blocks as we have previously. Sure. I think people feel a bit more safe calling their broker and crossing a block in that kind of space. The change in flow that we've seen is probably periodic auctions, SIs, and probably the lit primary books have seen a lot more flow, which was predicted as well before we came into MiFID II. And that's been in advance of the dark pool caps coming in, so the flow's already migrated before that's happened.
Right.
So we've seen that, but again, out of those three, the periodic auctions, the SIs, and the primary lit books, it's been different about where the flow's gone depending on which European index you're looking at. So that's quite interesting, and we'll see how that plays out.
Okay. And so your use of high touch versus low touch trading, was that as you expected? Has it entirely gone according to plan?
I think we haven't changed ours. I think most people in the market and us as well, we've increased the amount of low touch trading over the last couple of years. I think ours has probably increased by around 30% versus high touch. From MiFID II hasn't really affected it though, to be honest. It's probably stayed static, and unless we have a big change of our business model, I don't envisage it changing a lot.
Okay. So how did your trading team prepare for MiFID II? Were there any investments you had to make, any skill changes?
I think a lot of it was on the informational side. So we made sure we interact with our counterparties on a number of levels, finding how they are interacting with new and different types of liquidity, how they're building their smart order routers, interacting with SIs. One of the important points for us was explain to them how our trading strategies work and what we're looking for. So rather than just taking information from them, we're giving them information about us and how we'd like to act. So we've had a few of our counterparties build us some nice custom algos, and within those algos, we limit the number of venues we go into, or different types of venues, depending on the progress of the actual order itself. So I think it's the partnership between the buy side and sell side that we've been working on, which has worked quite well.
Okay, and you mentioned high frequency trading systematic internalisers as well as the broker systematic internalisers. How has your relationship with counterparties changed in terms of the type of counterparty, the makeup of them?
Sure, I think they've stayed largely the same. However, the different venues that we're interacting with and going to have changed. Mm-hmm. So models that we understand from the systematic internalisers and the HFT ones, we'll interact with those now and then monitor the data. Ones that we don't understand or haven't interacted with yet, we're not going to go in and interact with them until we understand the information and then model behind their business.
Okay, that's great. Thank you. As far as measuring execution quality goes, do you expect there to be any material impact on the way that you use transaction cost analysis? Because typically that uses historical data, and as order routing might be changed, perhaps those historical data patterns don't stand up now.
I think brokers that were smart, innovative, and access liquidity intelligently last year will be the same this year. So I don't think there's much change from that perspective. But I think you can only use the data that you have. You can't create data for the future, sadly.
Yeah.
So I think this is the point when you really have to take the quantitative data that you have, which is say last year's TCA, and the qualitative data that you have, the research you've been doing into market structure, microstructure of the market, how your counterparties are accessing liquidity. You need to put those two together to come out with a sensible outcome and decision.
Do you expect there to be any significant change to trading costs, and how might that impact the investment process from a portfolio manager's perspective?
It's an interesting question on costs. I think when there's more fragmentation, which there is with MiFID II initially, then I'd be surprised if we didn't see a very small uptick in implicit execution costs.
Yeah.
But over time, when we're going to get a lot more data and we've got a lot more transparency, I'd hope that the market's quite discerning in then switching off those venues which they find out are toxic or have large reversion figures attached to them. So maybe in time, and this is more of a longer term issue, will become less fragmented, and the market becomes more efficient, and hopefully kind of implicit execution costs come down. Sure. But from a portfolio manager's perspective, it's all changed. Unbundling has happened. We, for example, we're paying for research ourselves, and we just pay execution only rates. So on the explicit rates, it's a bit, it is quite new.
Yeah, so that's the unbundling of the research costs versus execution costs for any end investors watching. That's now quite a change, isn't it?
Indeed, it's a big change for the industry. Although, to be honest, we've been well prepared for it for quite a number of years. Okay.
And so if I was an end investor, what sort of questions ought I be asking of the trading desks on my asset managers?
I'd be asking how are you selecting your brokers? How are you selecting the counterparties that you interact with? Why are you using them? I'd also be asking questions around, do you understand the market structure changes yourself? I think gone are the days when you can rely on your broker or your counterparty to be an expert in the field. It's on the buy side now to become the experts and then explain exactly what kind of liquidity they want to interact with, why and when.
That's great. Thanks very much. McLoughlin, thank you for coming.
Thank you.
I'd like to thank Matthew McLoughlin, Head of Trading at Liontrust Asset Management. To hear the impact of MiFID II across the credit and rates markets this month, or to subscribe, go to tradertv.net. Thank you for watching.